Hello, I'm Greg Hunter. Welcome to USA Watchdog. Today's guest is Tom Cloud. He's an expert in hard assets. I've known him since the 80s. I would go listen to him talk about why it was important to have hard assets. This was back in the go-go years of stocks. Well, these days, Tom Cloud is very busy. He has a couple of thousand high net worth clients, 500 or 600, have a net worth of more than 5 million. He also has institutional clients. But today we're just going to talk about his man on the street clients. Tom Cloud, thank you for being with USA Watchdog today.
Greg, it's always good to visit with you. Even think back great times we had 25 years ago.
That's right. Well, listen, you are a busy man. I mean, you were telling me that 25 years ago you spent 5% of your time finding the metal and 95% of your time convincing people as why it was a good idea to have some part of your portfolio in precious metals. Now that's totally changed. What are you seeing today with your high net worth clients?
Well, I see the clients moving to a larger and larger percentage into gold and silver and hard assets because they feel their purchasing power is being confiscated. Not confiscated like they're taking the gold away, but they're taking away their purchasing power. And unfortunately, Greg, today for an investor, where there's no interest out there, it's really not a risk to be in metals. And when you look at something that's gone up 18.8% a year for 12 years in gold and 20.2% per year in silver, it becomes pretty easy to make that decision.
Well, there are some experts out there, the agencies, for example, are saying that, hey, you should move up your allocation to 45%. John Paulson, who was the famous, guy that bet against Towson, his fund is almost 45% in gold or gold stocks or assets. Is that what you're seeing with your clients? Physical gold allocation of 40 to 45%?
I do, Greg, and it's not me. It's always pushing it. I mean, there's just no other place. The stock market is at risk. There's no interest rate. Interest rates on long-term bonds have started up, so they know interest rates are going to go up and bonds will go down. And of course, I still predict the bonds will be the next killing field of investments, because I really think once this inflation gets in the system of all this quantitative easing, it's going to definitely bring bond prices down as interest rates go up.
What are your clients? What are your clients? There must be a fear factor here. No, nobody would put 45% of their money or more into precious metals if they didn't have some real fear. What do they fear?
Well, I think you fear that there's going to be some kind of new currency out there, and if they're in gold, they know gold will win no matter what, because that is proved historically throughout all the investment we've ever done. So it's important to them to have something that preserves their purchasing power, and they look at it that way. They don't look at it that they're moving into something. They're moving out of paper that's being quantitative eased all over the world. We've seen China, Japan, Europe, England, and the U.S. all have quantitative easing in the last 6 or 8 weeks.
Well, if they're expecting a new currency, that means they expect the old one or ones to blow up. I mean, if that happens, that's a financial calamity. Is that what your wealthy investors are fearing? Financial calamity, inflation, deflation, disruption in the system? Is that fair to say? Is that what they're telling you?
Yeah, it's fair to say, but some of them do think it's going to be a deflation and another depression. Others think it's going to be an inflation or hyperinflation, but they all agree gold is the one place to be. And I think the comment I get the most from wealthy investors is how much longer will the U.S. dollar be the petrodollar, because once demand for dollar goes down and countries don't have to buy dollars to settle their oil bills, then if China enters and says the Chinese yuan is going to be the next petro currency, the dollar is going to fall off the table. Everybody agrees on that if that happens. And I, for one, do believe that will happen within the next 2 years and probably even less than that.
That the U.S. dollar will no longer be the sole petrodollar.
Yes, that's what I believe.
Aren't they trading in? Aren't the Chinese buying oil in yuan right now?
Yes, they are, but everybody else in the world's not. Everybody's still using dollars to purchase. but there'll be a time soon that we feel the yuan will become the petrol currency, and a lot of my wealthier clients that get a lot of take a lot of high-priced advice, newsletters or whatever, believe that's one of the biggest risks they have out there is the dollar, because once the demand for the dollar goes down, our world credit rating is going to plummet. It's going to plummet.
Where do you expect gold prices and silver prices to go in the next year, 2 years, 3 years? What are you forecasting?
Well, gold I'm much more comfortable with because I'm talking about something that's going to go up either way. Silver is leveraged to do a lot better than gold, but it needs the world to stay out of a world recession - depression. Because we saw in 2008, in June 2008, silver went down 22% the last 6 months, and gold went up 8% because people were moving to gold. And it was the only thing that went up during the financial crisis. So I think silver, if we go into an inflationary mode, will take over 100 out in the next 3 years. I really believe that. But if not, you can see silver still down in the 25 to 35 range if the world, all this stimulation does not get the world economies going again. You could see silver still down there. But gold, I'm very comfortable that it's just going to continue to do the same 18.8% average it's been doing. And I'm sure most of your listeners know the rule of 72 in investments. If you divide a return into 72, it tells you how long it takes that investment to double. So I am very comfortable saying to you today that gold will be at $3,400, $3,500 in 4 years. That's 18% a year. 18 into 72 is 4 years. So I'm very comfortable saying that gold will double in the next 4 years.
Last question. Are you finding the gold and or silver market becoming tight? I mean, you're not buying, a couple of, gold eagles or, a roll of silver eagles. Are you seeing the silver and gold market tightening?
You do, Greg, and you see that easy through COMEX and IRAs. 2 years ago, you had to buy a Johnson Matthey or Engelhart to put into an IRA in this country if you were buying a silver bar. Today you have Johnson Matthey, Engelhart, Ohio Precious Metals, Academy, the Royal Canadian Mint, the Perth Mint. They keep approving more brands because they know at some point when people start taking future contracts, they've got to have the universe out there to get those bars and gold and silver. And in gold, we're now seeing places like Johnson Matthey making beautiful 10-ounce gold bars, a new product for them. But once again, because you think of Johnson Matthey, you think of silver. You don't really think of gold. But now they're making this beautiful 10-ounce gold bar that's a COMEX brand that can be used in futures trading or in IRAs. So, yeah, you're getting more and more people coming online, making more and more products. And as you said earlier, I used to spend 5% of my time sourcing material and 95% trying to educate people why they needed metals. Today it's about 2/3 education and about 1/3 of my time trying to find product, and that's only going to get worse.
What's tighter, gold or silver right now?
Silver's a little tighter on the bars, and the silver eagles are tightening up quite a bit also. But I'd say the silver overall is a little tighter right now than gold.
Tom Cloud, CloudHardAssets.com. Thank you for joining us today on USAWatchdog.com.
Thank you, Greg. Enjoyed it.